that we had qualification community of practice where we gather together all the lecturers of, in the contact space as well as online, all the lecturers of Become Entrepreneurship gather together to discuss. Actually, should we say Become Entrepreneurship, or is it just Bachelor in Entrepreneurship? Yeah, but as it is, I'm just focused on one module, as you know. And so it was quite interesting to see that a quick fact is that we saw that students were doing poorly for the two ACBPs, ACBP 1 and 2, your accounting modules, but they were doing well for finance. And it sort of gave us confirmation that, finance, you don't need to have done very well in accounting to take on finance. And also the second thing is finance is more clear in sort of I don't want to use the but I use the word already. Accounting can look a bit brainless, and finance would be there would be clear explanation of what you're doing. And so that's further confirmation to you guys that don't feel so. I'm sure that none of you is feeling that way, but don't feel like, okay, I didn't do well in accounting, so I should be worried, and perhaps I might fail because I did not do well in accounting. So that's the purpose of this. That would not be the case because generally students do very well in finance, even though they didn't do well in accounting. So that would be just to build your confidence. And we had this question at the beginning of the year from Jess to say that perhaps she should have waited. And Jess is here. Jess was asking if it would have been better to take finance after accounting, and that's not the case. You can take on finance without doing well, or even not doing at all. But obviously, doing well in accounting would be a good thing. Not to say that it's a bad thing. We're not saying that. We were looking at the number at the pass rate. We saw that accounting pass rate was poor, really very low. But finance, on the other hand, I think we are sitting at about 79% pass rate. You know what that means, guys. This would not be the module that you should fail, right? If we have such a high pass rate, meaning that the majority, 3/4 of students pass, you don't want to be, that minority that is failing the module. And it's quite clear to us as we were reviewing the whole qualification, especially for finance. It just requires you to do the bare minimum, or to do the right thing, not the bare minimum. Sorry to say that. To do the right thing, And as you can see on your screen there, I just want to go quickly, for example, something that I'm a bit worried. We have this pathway that I've been sharing with you guys, and not many of you are using it or utilizing it. So, for example, this is a pathway, right? It's basically to if you are about to start a learning unit, you might easily feel overwhelmed that there's so many things that you need to cover. And that's the reason I created a pathway for you. And it's very much in line with what we are trying to do to integrate AI, or we call it adaptive learning, right? But I have provided you something that summarizes for you quickly the main points, right? So that you don't waste time. Because when you're looking at, my God, I see theme one, theme two, and etc. It's might take me such a long time to complete. But if you just basically go to what I've shared with you, there is a podcast. If you are not into podcasting, let's say you are very busy. Many students have enjoyed the podcast because they were saying, look, even when I am driving, I can listen to a quick podcast. And if it works for you, that's good. It just gives you the summary of what the learning unit is. And I hope you guys have been using this, utilizing this. Right? And then you have but this is very important. The short learning videos are very important because they summarizes for you the learning unit in one part or two part or three parts. It's going to depend on um how large is the module is. But that's basically it, just watching a 5 to 7 minutes, always less than 10-minute video. I don't think that you could make a justification to say, well, I did not have the time, really. You can really do the bare minimum to already be done with the first step. And then you would move to the second step, where you will have basically a part two, which you can also cover, right? And that's it already. You would have already an overview of the learning unit. And then you would do the same as you move to part three. Obviously, now we're going to go through the notes. You have a proper lecture. Um, and here is the lecture. As you can see, this is your textbook. Whether you have a physical textbook or an ebook, there it is. So I'm going through the textbook, and you so that you know how to find your way through the textbook, because remember that you are examined on the textbook, right? So the textbook is still very important. But this is again for the student who just taking the textbook and reading through the textbook might be very, very difficult, even though I've provided notes. And as you know, those notes are here. If you look at the annotated notes, that will take you straight to your OneNote, as you are aware. So you have your OneNote, you have the annotation on in your OneNote, and make use of it, because sometimes you might look at an example, but you don't really understand how to solve the actual exercise or example in your textbook. And the annotation is to provide more meat to it, so that you can figure it out by yourself and understand. But that's already part of your practice, right? And obviously there is a mind map, very important. And I'll tell you why it is important, especially after you've done the homework of covering an entire textbook. But that's it, guys, right? And then the last thing, just before you come to an end, you have your Ask Task 4. It's there. You don't need to be looking for it. I already provide you the link to the Ask Task 4, so that you can complete your Ask Task 4. Remember that this is free marks for you, 10% that you should not miss out, right? And then it will provide you access to the past papers that are also in your OneNote. In a nutshell, this can be done easily through the week. So there shouldn't be an excuse why you would really tell me, listen, I was really trying my best, but I just did not have the time. Because this requires you really the bare minimum to be able to cover, the most important parts of your learning unit. All right, guys. So I hope this is clear to all of you. If you are having any issue really to cover something like this, right? Remember, learning unit 3, you have the same type of summary that is provided. We'll call it more a synthesis. Learning unit 2, I also provided the same. So guys, please make use of it. And you will understand why this will be important when you close to your exam. You're not going to have time to go back and then study each learning unit so that you can prepare for the exam. You cannot do that. You cannot do that when it's time to exam. You need to have a proper summary that you can look at, and automatically it provides you the overview without you having to go back and having to restudy. You will find out that you are doing double the work. And that will be very discouraging for you. And I don't think that you would want that. You want proper summaries. If you are making your own summaries, much encouraged. But if you would like to use the summaries that are already provided to you, the synthesis that are provided to you, feel free also to do the same. I hope this is clear, right, guys? Okay, so let's move on quickly to the mind map. So this is a mind map. It's very much in use. And this is all about the adaptive learning that we're trying to bring to you. So quickly, you can look at your learning. You have access to the other learning units, obviously, but you can quickly look at your learning unit 4, right? And look at these two. And this sort of tell you this is the two main things that you need to remember, that you need to understand or remember about this learning unit. Okay, the cost concept. And here you are provided with, for example, production versus non-production cost. We want to drive into you. And remember again, here we are introducing you to managerial accounting as opposed to financial accounting. As you know, the financial accounting follows quite strict, rigorous international standard. And the financial accounting is very much to speak to other stakeholders outside the company. But managerial accounting, on the other hand, speaks to, it's more of an internal exercise. Thus, as you can see by the name itself, is managerial, which is managers. This is what managers would use, right? So you have this categorization, which I want you to clearly understand. You need to be able to look at a cost and to know where do I categorize, or where do I put this cost? What is the category of this cost? And that's it. That's the full exercise here, right? Obviously, your production costs, it's all these expenses that are incurred when you're converting the materials into the finished good. And that's all. These are directly related to the product. Guys, no mystery there. And obviously, costs that are not related directly to the product or the production are categorized as non-production cost. Right? So very simple. But they are within this production cost, obviously, you have these three elements that you would have, for the rest of the learning, or the module. Very important. I call them the three musketeers. Just an easy way for you to remember them: direct material, direct labor, manufacturing overhead. Obviously, the manufacturing overhead is indirect because we have the two direct costs there: direct material, direct labor, right? So if we are producing, for example, a chair, the wood is the direct material. The people who are going to physically assemble the table or any wooden object, that will constitute a direct labor because they are touching the product physically, right? So that's the two categories there. But everything else will become overhead, meaning indirect, because it is not directly related. For example, indirect labor. For example, indirect labor, when we say the salary of the manager does not physically touch the product, but it's still a production or a manufacturing cost. So just a quick break here. Is this clear to all of you? that distinction between the direct and the indirect, but still they fall under the manufacturing cost or the production cost that have to do with the actual product, the finished good, making the product, converting the material into the finished good. Is this clear? You can use your thumbs up, or if you have a question at this point, feel free. It's clear. It's clear. All right. So, and as clearly as that, the non-manufacturing, non-production costs, these are directly related, but to the manufacturing. They are not, they are indirectly related to the manufacturing, right? That's why we call them non-manufacturing or non-production. Within these, there's two categories, which is the administrative cost and the marketing/selling cost, right? These have to do with order gating and order filling type of exercise. When, for example, we have manufactured, the product and we need to deliver that product, or we need to do the marketing, of that product. All those will fall under non-manufacturing because at that point, the manufacturing is complete. But in any case, even if it's not complete in your brains, just put it that it is not directly related to the manufacturing, right? Okay, so that's a good way to synthesize for you this definition and explanation, right? Another very similar concept would be now the product versus the period cost, right? Product cost, like it said, it is attached to the units that are being produced, right? It is the same thing again. It's going to include the three musketeers, which is direct material, direct labor, manufacturing overhead. So you would say, wow, product costs and production cost or manufacturing cost are the same thing. Yes, more or less similarly the same thing. All right. But the only thing that we want to distinguish, we want to distinguish between product cost and period cost, because period cost would have to do with obviously costs that are not product cost. They are not, they're not related or attached to the actual product, which would be the same as your selling and administrative cost. But the reason why we are providing you with this is that you need to understand where would this cost be, either on your balance sheet or your statement of comprehensive income. That's all. Where are you going to put this cost? How are you going to relate it? So for example, for period cost, these will be expenses that you have on your income statement. And I'm sure when I say income statement, all of you know what I'm talking about, right? In your brains, or already you see revenue minus cost of sales equal gross profit minus operating expenses. Guys, this is now should be second nature to you, right? So you need always to have that representation. When we talk about income statement, it should pop up in your brain straight away, right? So some of those costs that will be there on that statement of comprehensive income will be the period cost. But that's slightly different with the product cost, because these costs are treated as inventory on the statement of financial position, your balance sheet. I hope now you see product costs, they go on your balance sheet. What comes in your mind when you see balance sheet? Asset, liabilities, equity, right? So when you're looking at your inventory, which is where? Where is your inventory? In your balance sheet. I have 4 people here. Come on, guys. Where is your inventory in your balance sheet? You have a chat, you have microphones. Where is your inventory in your balance sheet?
So I think it's in the current assets.
There you go. Jess, actually, you should not say I think. You should say I really emphatically confirm that it is in the current asset, and you are correct, right? So, and that's what we want to show you is that these costs will be there. These are inventory because remember, why are they inventory? Remember again the logic. We finance it has always to make sense. It must always be logical because you are buying these raw materials and this is an inventory that you are purchasing. So from the start, you first buying the raw materials that you are going to convert into finished product. But you first need to buy the raw materials to make a chair, to make shoes, whatever it is, right? You are buying the leather as being the raw material. And then after transforming that raw material, then it becomes a final product. So for that first phase, it has to be there in your balance sheet, like Jess said, under the current asset. It is an inventory, right? But when the product is actually sold, there is no more production involved. The product is now sold. Then it becomes an expense in the cost of sales. Because when you are selling a product, where do you move to? You move to the income statement, to your actual sales. Does that make sense to you guys now? Because you have now your sales because you have sold the product and what you bought as an inventory, as the raw material, is now part of your cost of sales. Very logical, right? Makes sense, guys? Okay, so I'm going to move. So that's basically, it more or less says the same thing, but with product versus period cost, we want to show you, especially you especially, sorry, as an entrepreneur, right? You need to picture these things when you're doing, and again, it's just to give you that quick thinking. As an entrepreneur, you need to have the skill, and that's why we provide you with the financial skill so that you are able to represent yourself quickly. Where is each item? And how am I going to move, right? About. Okay. Another classification here would be controllable versus uncontrollable cost. There are costs that are controllable by the manager, right? We can manage those costs. But there are also costs that we cannot control, but are sort of imposed upon us. For example, municipal taxes. We have to pay the tax. It's not something that you control, right? Sunk cost. And I'm sure, many of you will be able to go through the theory, but just quickly, sunk cost it's a cost that has already been incurred, and we cannot change it, right? That it's definitely irrelevant to our decision making, but it has already incurred. I think a good example here. This is a good example. A company pays a non-refundable 10,000 rand for a long-term factory lease. It has already incurred. We can't change that. So when we would like to lease, especially when it comes to industrial leasing, we pay in advance and we pay for a long period. Once you've paid that amount, there's nothing that you can do. You can't go back and ask for the money back, right? It cannot be recovered, right? So it's it has no influence on our future production decisions. It's something that's a given. There's nothing we can do, right? Opportunity cost, on the other hand, is quite an interesting concept. And some of you might, if you do not properly understand it, you might get into trouble when you get a question where you are asked, what is the opportunity cost? The opportunity cost has always to do with the alternative of the the decision that we've taken at this moment. And I think an example will tell everything, right? So whatever decision you're going to take, so you have two scenarios. If you choose one, the benefit of the other scenario or of the alternative choice that you could have taken, but you didn't, the benefit is always an opportunity cost, right? So you are giving up on uh, one choice to take another choice, right? Does this make sense? So an example perhaps will make it more clear. So if a business owner uses their personal savings, and that's the amount there, 100,000 as a capital, the opportunity cost is the interest they could have earned by keeping the money in a fixed deposit account. All right, so you've made a decision, you've invested, so the owner has invested in his own company, has provided his personal savings as capital, but he could have done something else with that money, and that is an opportunity cost, a forfeited opportunity cost. All right, makes sense? And that's and as you can see, it's very quick when you have a mind map, right? And the final thing would be the cost behavior. This is very important, but I'm sure that you know already this is not going to be a big problem. But when we speak about cost behavior, when it comes to fixed cost, as you can see, it's fixed, it's constant, it doesn't change, it doesn't have ups and downs. Right? You pay a rent, and this is the amount of the rent, right? Your insurance is this amount. It right? But we want you to understand that the more you produce, so the total fixed cost is static, doesn't change, doesn't move. It's one amount. It's a flat line. That's your fixed cost, right? But your total fixed cost doesn't move, it remains the same. But what about the fixed cost per unit? Surely the more you produce, then the lesser that fixed cost per unit would be. So that fixed cost per unit will decrease as the production increases. And that's what we mean by a cost behavior. How does it behave, this fixed cost? And this is always very interesting, especially this is really a key and very fundamental concept when it comes to managerial accounting. So if you would like to do future managerial accounting and you need to start loving this kind of concept. What about the variable cost? The variable cost, as we know, it will increase with the production. So it moves together with the production. The more you produce, the more the variable cost increases. But that variable cost per unit, that doesn't change. If it costs you 2 rand to produce a chair, that 2 rand doesn't change, no matter the amount of chairs that you're going to produce. You can produce 1,000. Obviously, the total variable cost will continue to increase with the production. And if the production goes down, that variable cost also goes down. We understand that. But that cost per unit doesn't change, it's constant. But it's the other way around with the fixed cost. The total fixed cost doesn't change, but the fixed cost per unit obviously changes with the production. So if the production goes up, that fixed cost per unit goes down. Make sense? Just taking another quick break every 15 minutes just to find out if you are still with me. Does this make sense?
Hi, sir.
Yeah, it makes sense.
Yeah.
I just have a question.
Yes.
With the variable costs.
The variable cost.
Yes, yeah. So my question is, let's say you use zinc as a raw material to make
Yeah,
is like item, and the prices of zinc always fluctuate. Will that
yes.
have a impact on your variable costs?
Amazing, amazing, guys. And this is a very brilliant question. Indeed. So Auntie, you are correct in that case, but by the time that you are purchasing the zinc, right? Even if that price fluctuates, but you are purchasing raw material at a specific cost, right?
Yes,
So if let's say this month you purchase that the zinc, maybe let's say the cost was 5 rand per meter. It's just an example, right? But then, yes, indeed, because the raw materials, the price fluctuate. In the next production, obviously, it could go up or down. I understand that. But once you have purchased it, that cost doesn't change, right? So we know that you purchase the raw material at a fixed cost per unit. So it's not like you're buying some zinc at 10 Rand, other zinc at 15 Rand in the same production cycle. That wouldn't make much sense, right? But your question is very much relevant because as we move to Learning Unit 5, you might find out that we're going to study something called the FIFO, first in and first out. And your point is very relevant. There will be circumstances where we will now need to take into account the fluctuation. But that fluctuation is not when you are purchasing on at one point in time. So this is when you purchase at one point in time, and therefore the variable cost per unit doesn't change. Right. Okay, guys. So that's it. That's it. So that's all that you need for your first part. That's all that you need to keep in mind is that I will need you to understand what are these costs and how you categorize these costs. And I will show you just before I go to let me see if I can actually show you. So just give me a couple of seconds because I will just need to stop sharing and move my screen to. There we go. Right. So you let me know if you can see. And I'm just going to go quickly to our learning unit. So this is in your textbook, your ebook, right? And when you are going through your textbook, please remember to do this exercise. Very important. Because you might say, well, but this is kind of futile. But we give you a long example. And the purpose of this is just to be able to find out if you know how to categorize your cost. There you have the period cost, and then you have the product cost, right? You have your marketing, distribution, and selling cost, which is non-manufacturing, and administrative cost, which is non-manufacturing, and then you have your product cost there. You have the three musketeers, right? Direct material, direct labor, manufacturing overhead. We want you to be able to look at such a long example and to put the correct cost in the right place. This is important. This is an exercise you need to do. You need to practice by yourself. Because when you are in the exam, messing up on something like this, not knowing how to properly fit a cost within a specific category, can cost you a lot of marks. And remember again, you know the trick with finance is that everything leads up to the next. So if you start getting things wrong at the beginning, it's going to mess up your entire calculations. You don't want that. Because why? We want you to know the basics and not struggle with the basics where you don't really know where depreciation on an office equipment would go. But it clearly says there, it's a depreciation on an office equipment. Now you need to put yourself, wait a minute, office equipment, this is administrative. It has nothing to do with the manufacturing or the plant. So read carefully, understand the context. This is an office equipment. It is in the administrative building. It is an administrative cost. It has nothing to do with the production cost. And the reason why I take my time to tell you to be careful is because if you don't take this one, if you don't tread carefully here and make sure you fully understand how to categorize how to classify the different costs, it could be disastrous. All right? Advertising and distribution costs. You would know that this has to do with the marketing and distribution and selling. We are practicing, right? Import tariff. Well, where would the import tariff go? Import tariff and customs duties that we pay on this material that we are importing from abroad. Wait a minute. Where does this go? Obviously, this has to do with, this is a cost that is added to the raw material that you are buying. It is your direct material. It is your direct material. Direct material will include not only the cost, but all these added costs, for example, import and all that, to make sure that the material comes to your manufacturing venue or plant. I hope this is clear, guys. I want you to do this, and I repeat it again. The reason why I have to repeat this is some of the things that you need to do. It's an example in your textbook. Go and practice it. The solutions are there, but I want you to practice it by yourself first. Do it so that you understand how to classify the different costs, right? Very important. Once you do this, it's going to be helpful to you, right? Okay, so we're going to move on. Please give me 2 seconds as I move to the second part, which is the break-even analysis. And you have two concepts here that are beautiful. Once you understand them, you would rest in peace for the rest of the module, right? Once you understand this, very good. So the CVP analysis, cost, volume, production, right? Analysis. Cost, volume, production. Very important. Whatever you're going to be involved in, you need to understand this. The cost, volume, and profit analysis, right? So when you're looking at the cost, volume, profit analysis, you examine the relationship between cost, the sales volume, and the profit. The concept here is marginal income. Aha. And what is this marginal income? Very important. Everything is synthesized for you. That's what you call also contribution margin. I'm not sure if you have come across this as a concept, contribution margin, but it's something that is very important for you to understand. What you do to calculate the contribution margin is very simple. You just take the sales revenue minus the variable cost. Not all the cost. What is your total cost, by the way? Your total cost is fixed cost plus variable cost. You know, if you're looking at those two categories, right? So you will take the fixed plus the variable, you have your total cost, right? Very important. And when it comes to the CVP analysis, you are looking at fixed and variable costs. Very important. That's what you are looking at. So all the other costs needs to be recategorized as, is it a fixed cost or is it a variable cost? Is rent a fixed cost or a variable cost? Rent is a fixed cost, right? So every other cost there need to be properly recategorized to fit, is it a fixed or is it a variable cost? At the end of the day, you need to take the sales revenue minus the variable cost. Why? Because that's what we call the marginal income. It is that amount that is available to cover something very important, which is our fixed cost. And this fixed cost, right? Once this fixed cost is covered, whatever money you make on top of that becomes your profit. It is directly your net profit. Right? For example, the rent, like we said, you need to pay it. It's a fixed cost. So you'll find that every business out there is trying its hard to cover those fixed costs because many of those fixed costs are sunk costs. There's nothing you can do about it. This is something, in other words, let me give you a good illustration. This is so whatever money we're making is just to keep the lights on. And you've heard this. You've heard this from many businesses, from many entrepreneurs, that this is just to keep the lights on. In other words, we need to break even, to cover those fixed costs so that after that, then we can start making money. So I don't know if by this, now you clearly relate to what I'm saying. Okay, let's take a practical example. So you have a shoemaking business that sells a pair of shoes for 10 Rand, right? The variable cost to make and sell one pair is 50 Rand. So that's the variable cost. So to make and sell a pair is 50 Rand. The marginal income or the contribution margin, we will need to take the sales, which would be 100 Rand, because that's what we're selling the shoe for, plus the variable cost to make that shoe, which is 50 Rand. So the other 50 Rand, the other half, that's our contribution margin. That's our marginal income. And the purpose of that marginal income is one thing, to cover our fixed costs. For example, to just put the light on, sorry, the light on with the factory rent, we need to reach 5,000 Rand. So you would take this 5,000 Rand divided by 50. It will give you 100. So we need to make 100 pairs in order to be able to cover our fixed cost. Does this make sense, guys? After we've made those 100 pairs, now we can start making money for ourselves, right? Now we can start making profits, right? But we always have in mind, guys, we need to reach those 100 pairs so that we can still keep the lights on. Because if you don't pay the rent, well, there would not be any production. They will come and shut you down. All right, so that's basically, that's it. The concept of contribution margin is very important. I hope that this synthesizes it for you, but should you struggle, please try to read a little bit more. Then how do we, armed with that, how do we make other calculations? How, for example, do we make the calculation of the break-even point? What is, by the way, the break-even point? The break-even point is when we have covered our fixed cost. Or another way of putting it, when our total revenue equals our total cost. That's beautiful, right? So at that point, when our total revenue equals our total cost, we're not making money or we're not losing money. So there is no profit, there is no loss. That's why we call it a break even. We're breaking even, right? Even on the same level. Total revenue must equal the total cost. Guys, I trust that this is very clear, right? So it's that minimum number. So when you're looking, for example, at the break-even point in terms of units produced, so that would be, we've reached that number, that minimum number of units when the business needs to, that the business needs to sell to start being profitable. So these break-even points per unit, how do you find it? We already spoke about that, right? You take the total fixed cost divided by the marginal income per unit, right? We spoke about that marginal income, that's contribution margin, very important. Why do we talk about the contribution margin? It's just because of this type of calculation. The contribution margin is always in relations to our total fixed cost. It is there to help us find out what is our break-even point. That's the purpose of it. All right? Here is the example that is in your textbook. Okay? Letsema Furnishers has a total monthly fixed cost of 20,000 Rand. And now we know that that 20,000 Rand need to be covered, right? Before we start making profits. All right. So the selling price of its JSS product is 3,000 Rand. That's the selling price. The variable cost per unit is this amount, 1,613, right? So very easy. We know the variable cost per unit. We know the selling price. 3,000 minus the variable cost per unit, that's basically our contribution margin. So now that we have our contribution margin or the marginal income per unit, we take the total fixed cost of 20,000 Rand divided by the marginal income per unit. And that's it. What does it give us? 14.42, which is basically, we can round it to 15 units because you can't have a 0.4 unit or half a unit, right? You can't have half a unit. So it does make sense that we round it to 15. So we know that when we reach 15 units, we would have covered everything. We would have broken even. Does that make sense? Is it clear, guys?
Yes.
Any questions? Perfect. So, and that's it, guys. That's it for learning unit. These are the two main things. But obviously, what I want is for you to understand the theory very quick. Get it right quickly. You only have 2 weeks. Make sure that by the end of this week, you have covered, and like we've gone through the theory, you can see that it's very easy to understand. The problem now is that, but where does it get difficult is where you did not practice. So please begin now the practice, because as soon as you look at some examples and you begin to practice, obviously, you know, we could give you very difficult questions, very long questions, but as long as the basics are covered properly, you have nothing to fear. You will figure it out very easily. All right, guys? So shall we then say, since there are no questions and you know you have your flat schedule, I think that you would be good. But remember again, for learning units, you have 2 weeks, by the way, 2 weeks to your task 2. Please don't waste time. If you have any questions on learning unit 3, feel free to put it in our chat. Let's work together. Share with the entire class so that we can work together. It's always very good for practice. And yeah, I think that we are good to go. All right, guys? So I'm just going to stop the recording here. Jesse, are you good? Hanti, are you good?